Hi, what's going on, everybody? My name is Mr. Leong, and welcome back to Business Basics and the Startup Starter Kit. So, hope you've been enjoying the episodes. We're in the midst of the money management unit where we're learning how to manage our finances, manage the cash that we make from our sales. And now, today's lesson is going to be focused on financing. How do you finance your company? What are some different ways you can finance your company? Because when you start your company, you're going to need cash because you have no sales to start out with. And a lot of times you need money to buy the essential supplies, the equipment, advertising. So all of that needs cash. So where is that cash going to come from? So we're going to be learning about two ways in which we can get cash for our company. And let's get started. Make sure to subscribe to my channel for some more content and let's begin. Alright, financing means you're looking at ways to get the cash and money you need to first start your business. My golden rule of business is in order to make money, sometimes you have to spend money. So I've been watching these TV episodes of this TV show called The Great Food Truck Race, and they often get seed money to buy the food in order to prep to create a product to sell to customers. So you need some seed money or some money, and you obviously want to spend some money on advertising, promotion, social media ads, and all of that costs money. So how do we get money to first start our business? Many businesses are unsuccessful because they underestimate the money that they need to run their business. So you need to have short-term and long-term goals. You need to be able to have enough cash to carry you for those next few months, and you have to be able to learn how to budget. A lot of businesses tend to underestimate their needs because they don't take into account things like rent, administrative expenses, legal expenses, promotion. So all of that costs money. And also, if you're selling a product, that product is going to cost money. Time is also a factor as well, but that's not really a monetary cost. So plan ahead and make sure that you plan for the months ahead, that you have enough money saved up just in case your business doesn't start out as well or you don't experience the growth that you have to sustain yourself. So make sure you have enough cash to remain operational. So there are two main ways that you can get money for your company. It's debt or equity. Debt or equity. These are the two main ways we finance, and all of these ways we can finance falls into these two categories. Now, this will all depend on your type of organizational structure. So if you are a sole proprietorship, obviously you can't sell shares of your company, so you're going to be relying on debt. Most companies usually have a mix of funding, so they're going to invest a little bit themselves, but they're also going to borrow money. So debt is a liability. You're borrowing money for your company and you're going to pay back that money plus a little bit of interest. So a common form of debt is bank loan or a loan from a friend. So they're going to lend you money and or you're going to get a loan from the bank. Then you have to pay back the bank with a little bit of interest. And you maybe make some payments monthly on the principal, which is the original amount, plus a little bit of interest. Equity relates to funding where you sell ownership of your company and you don't have any liabilities. You sell ownership of the company in exchange for cash. So basically you're getting investors into the company, and that's one way you can finance your company as well. A lot of people often put their own money into the company to help the company start out. So they're going to put some of their own personal money and they become a shareholder of their own company. So debt and equity. So what are some of the pros and what are some of the cons of each? Let's start with debt. Debt is a common form of financing where you borrow money from a bank. It's like a personal loan or a third party, and you pay back the principal amount plus the interest. So if you went to the bank and borrowed $10,000, you're going to pay back a payment on the 10,000 plus any interest, so maybe 1 or 2% interest. So debt also includes credit cards, auto loans, any mobile contracts where it's payable. So credit cards are by far the worst type of debt you can have as a business because it's often like a 22% interest. So I would avoid credit cards, but there's short-term and long-term debt. So a lot of people like to take advantage of short-term debt and they have credit cards, which is a common way of financing, or they will borrow some money for a short term, like 3 or 4 months, and then pay it back if they only need it for a short term. There's also things like long term, so like a mortgage, or if you're buying some property, plant, and equipment, and then that's going to be a longer term liability where you're going to pay back the principal plus the interest. There's also some government loans and programs that can help you to start out your company. So this is a liability. Liabilities are debts, and these are monies that you owe to people or companies because they've lent you some money. So here are some of the pros and here are some of the cons. Here's why people like debt. When you're experiencing growth, a lot of people like to take debt in order to fast track and to help grow your company. Here are some pros. You get to keep ownership of the company and decision-making power. Really important, because when you sell shares of your company, you lose the ability to make decisions and you lose that decision-making power. And if you have a debt, once you pay off the debt, you're free. You've paid off the interest, the principal, and you can even deduct the interest paid on your liability as an expense. So it's a great way to take advantage of low interest rates. You can also refinance too. So if your company is doing well and you have a liability, you can start to pay off your liability a little bit less and less, and you can take advantage of a lower interest rate, or you can pay early, and that's also an option too. And you also get to build up business credit. So once the loan is paid off and you've paid off the liability, you're good to go. But here are some of the problems. It's kind of hard to get a loan from the bank, especially for your full amounts, if you're not established or you don't have a good business plan, or maybe you have bad credit. And they often require a collateral. So I've seen some shows like Kitchen Nightmares, and people have put in their homes as collateral, and if the business goes down, then they lose everything. If they're personally liable, if they're unincorporated, like a sole proprietor or a partnership, and you have all of these outstanding debts, then these creditors can actually go to your personal assets and claim them, so they can take your house and take your car. So it's a little bit risky. You're also obligated to pay back the amount even if you have no sales or no money. So if you're not making any money, you still have to pay those liabilities, so the principal and interest amount, because maybe you have a sort of fixed payment schedule where you have to pay the amount. Borrowing too much can also sink your business. If you're borrowing like $500,000 or $1 million and you have these crazy principal and interest payments, then this can lead you to bankruptcy. It's kind of hard to pay off those debts and liabilities if you don't have a consistent cash flow. So if you're not set up and you don't have that income, then it can be a little bit risky and scary. And you also need to watch out for certain performance measures. Sometimes creditors will say, oh, if you go below this amount of cash, then we call back the loan. So you have to be a little bit careful about debt. In great times when the business is doing well, a lot of people can take advantage of debt and you can grow. But you also have to watch out, because if you take on too much debt, then you could be liable and then the business can go bankrupt. Equity. Equity is related to capital funding. So this is where you sell ownership of your company and you get money in exchange and you give up control of your company. So the owner becomes a shareholder and they are entitled to a piece of the pie or a piece of the company, and they're also entitled to some of the profits as well. Anybody can become a shareholder of your company. It can be private, like family and friends, or you can go public and you can have an initial public offering where anybody in the public can buy shares of your company. So capital funding, you sell ownership in exchange for cash and you don't take on any liabilities. But the people you take on also get control of the company and they have decision-making power. So if you sell 40% of your company for $50,000, then the inherent value of the company is $125,000. So if you ever see shows on Shark Tank where they sell ownership of their company in exchange for cash, this is what they're doing. They're doing equity funding. Here are some of the pros and cons. Pros. Less risky, I'm going to say, and there's no collateral because you don't have to pay those principal and interest payments like a liability. These investors are there for the long haul, and it's great for cash flow because you don't have to pay back any principal or interest, and you don't have to pay back the investment. So going back to this example, if somebody invested $50,000 into your company, you don't have to pay back that $50,000 because they're permanent shareholders. You get investors on the team that can help you with decision making for the long term, and you can also offer different types of ownership and shares. So maybe you give out some shares or ownership of the company and they have the ability to vote only, or maybe you give up different types of ownership and they get some profits of the company in the form of dividends. So that's also a disadvantage of equity funding, is that when your company is doing really well and you have to share some of those profits, then you get to have less of those profits because you don't have as much ownership of the company. You get to there's a con of the equity funding, which is you dilute and lose ownership of your company. So it's also really hard to make decisions. So if you sell 51 or more of your company percentage wise, that means that you don't own the company because you're not a majority owner. So that means that you're losing control of your company, and you distribute a portion of the profits to the shareholders. If you have debt financing and you're making a lot of money, then you get to pay off the liability and the profit is all yours. But if you're doing equity funding, then you have to share some of those profits. It's also hard to attract investors if you don't have any sales or records, so you need to be vigilant about reporting. So here's some questions to think about when you think about debt or equity. So how much money do you have? Are there any assets that you can put into the business for use? How much money do you have to start the business? What are your short-term goals and what are your long-term goals for cash and financing? And what are your potential sources of funding? Is it more important that you have control of the company, or are you okay with a liability? So these are things to consider. Most people have a mix. So they're going to invest some of their own money as equity, and they're also going to maybe borrow some money from the bank because they want to buy some equipment. So having a mix helps to diversify some of the risk. Hope that helps. And I also want to share a few resources. I live in Canada, so the government of Canada also has a variety of ways in which you can help to finance your business. So you can get loans, you can look at private and public sector financing, leveraging personal assets, and there's also some credits for inventing new products such as the SR&ED credit. So my advice is talk to a bookkeeper or accountant, and they're going to give you some more advice about what to do and how to finance your company. So I'm just giving you some of the theory behind debt and equity financing, but it's important that you make your own decisions yourself and you think about what's best for your current business situation. Hope that helps, and hope you have a great day. And that was how to finance your company. So you can borrow money as a liability and then pay back the amount of money plus interest, or you can sell ownership of your company, but you lose some of the profits because you have less ownership of the company. So debt and equity, and that's it for today. See you later, everybody. Don't forget to subscribe, okay? Bye-bye.